All right, bull runners, welcome back to the channel. So we have a chilling warning for all investors. If you're holding XRP, maybe you're holding Bitcoin, you're holding Ethereum, you're holding Shiba Inu, any altcoin. If we go on coinmarketcap.com, there's over 1.8 million cryptocurrencies with the total industry market cap sitting around $1 trillion. And in this video, I'm going to be getting into the price chart for XRP, what's about to happen next, also what the Fed is doing, talking about inflation. We're getting into the inflation, the CPI report, the Fed watch tool for the next Fed meeting, US recession predictions, talking about CPI, we're talking about GDP, we're also talking about total outstanding credit card debt in America, the 10-year to 2-year Treasury yield inversion, how every single inversion affected the stock market and corresponding to the crypto market, and what the Fed plans to do next that will affect all of your portfolios. What that means for you, what that means for your retirement, your bank account, and your future. So is it time to buy the dip, or are the markets going to go lower? We're discussing all of that in this video. So comment 777 if you're feeling blessed. Comment 777 if you're feeling bullish, and let's run it. All right, bull runners, welcome back. So is it time to buy the dip for XRP? And will there be a retracement in the near term? Because in yesterday's video, I talked about this upward trending support line right here. If XRP were to continue seeing a sell-off to the downside with these liquidations taking place, I would expect a bounce off of this support. Now, don't buy XRP. Don't sell XRP. XRP is sitting at 49 cents right now. This support is about 41 cents. But one thing that we can look at is data. I'm going to bring you educational material only. It's not financial advice. What you choose to do with this information is up to you. But when we look at the RSI, the relative strength index, XRP on the daily candles is sitting at 24. It's in drastic oversold territory. The last time that we were in this territory was all the way back in June of 2022 when XRP was all the way down at 32 cents. And conversely, when we saw XRP bounce from this range, we saw some consolidation sideways, but XRP traded upwards of 41 cents, and that was the best possible entry point for 2022 for XRP. So I do feel even if XRP goes lower, I personally am going to be accumulating more. So this does not scare me. This actually gets me excited. Yes, we did want XRP to rebound off of the 58, 59 cent support and break out of here like it did back before the last bull run of 2017 when XRP saw, it was like a 70,000% growth or something like that. But this time is different. So the last bull run is different than this bull run because we have some major macro problems, macroeconomic problems. So when I look at the chart, to predict what's going to happen on the chart, we need to expand our horizon here and when in doubt, zoom out, because Fed officials see an upside risk to inflation, possibly leading to more rate hikes. So I wanted to discuss what those rate hikes are going to do, not only to the crypto market, but to the overall economy, because the sentiment right now for investors that leads to a chilling warning or a dire warning is uncertainty right now, because, while there's an agreement that inflation is unacceptably high, it's at 3 point something percent above their 2% target. It was a lot higher months ago, but there was an indication that a number of signs that inflation pressures could be abating, and almost all of the meeting participants, which include non-voting members, were in favor of a rate increase, and so they're most likely going to be going higher, 25 basis points for a few more meetings. Some people thought that skipping a rate hike and watch how previous increases would impact economic conditions would be a good idea, but nonetheless, they're going to keep going higher because when you look at inflation, 3%, even the last rate hike, is 3.2%. And so they're still going to have to keep going up by about 25 to 50 basis points. Now, I don't think they're going to go 50 to 75. I think the Fed in the next meeting is going to raise the effective federal funds rate by 25 basis points. I could be wrong, but when we look at the Fed watch tool, 90% are expecting 25 to 50 basis points. Only 9.5% are expecting a 50 to 75 basis point rate hike coming up on the 20th of September. So you have until the 20th of September, and then by November 1st of 2023, 66% are expecting 25 to 50, 31% are expecting 50 to 75, and 2.6% are expecting, a full 75 to 100 basis point rate hike. And then by December, still 63% are expecting 25 to 50 basis point rate hike. Then by January, 54% are expecting 25 to 50 point. And then we see right here, 500 to 550. It's kind of all over the place right here, but by 2024, so going higher slowly by 25 to 50 basis points by 2024, and then the Fed will be eventually eventually pivoting. That's when the Fed pivot will come. And I'm going to talk about the Fed's balance sheet and why that is one of the most important things to look at in terms of liquidity to flow into the cryptocurrency market, because Fed economists are making a course correction on their US recession predictions. So if there is a fear of a recession on the horizon, then big investors are going to be holding on to bonds, cash, and they're just going to be keeping money in risk-off assets that don't fluctuate as much. Yes, cash is trash as it bleeds out with inflation, but when you see crypto crash by 10, 20, 30%, well, that's a lot worse than cash crashing 5% to 10% over the course of 12 months when you see crypto crash 15% in 1 week. So the first 2 quarters of 2022, we saw the U.S. economic output contract to 1.6% annual rate from January through March, and at a 0.6% annual rate from April through June. And though not technically accurate, the definition of a recession, the country had already entered a downturn. And so when we go right here to the real GDP percentage change from the preceding quarter, and you guys look, quarter 1 of 2022 and quarter 2 of 2022 were negative. So technically we're in a recession. Now, why didn't Biden or other politicians come out and say we'd entered a recession? Because if they did, what do you think would happen there? That would freak people out. So they just changed the goalpost on the definition of what a recession is. Because if they said, imagine Biden coming out and saying, hey, we're in a recession. People are just going to stop spending money, and that's going to make things even worse. Then quarter 3 would have even be worse. So the fact that they came out and said we're not in a recession, then quarter 3 of 2022, we saw a GDP between 2 and 4%, and then we've seen it in the positive. But that doesn't mean that things are good, because I'm going to talk about real and nominal, and what that means and how they just change definitions. They can change the basket of goods, and they can manipulate data however they want to try and shelter people from what's really going on. But we're here to deliver you the truth on our channel. And if you like the truth, go ahead and subscribe to the channel. So the Federal Reserve was quickly cranking interest rates higher. Housing investment seemed to be buckling, and the conventional wisdom was that other industries, consumer spending and the job market would all tumble. But a number of forces have coincided to slow economic momentum more rapidly than we previously expected. The chief U.S. economist at Bank of America said in July of 2022 that we now forecast a mild recession in the U.S. economy this year. In addition to fading of prior fiscal support, inflation shocks have eaten into real spending power of households more forcefully than we forecasted previously, and financial conditions have tightened noticeably as the Fed shifts its tone more rapid, increasing in its policy rate into the effective federal funds rate. And when we look at the perceived recession risk, right, it's fallen a little bit, but it's still, around 50%. So economists polled by Reuters began boasting the odds of an expected recession after the Fed's interest rate hike in March of 2022. It rose as high as 65% last fall, but has now been coming down as, less than 50% are expecting a recession. And with the failure of California-based Silicon Valley Bank expected to put an extra constraint on bank credit, and other banks potentially seeing a bank run and collapse with the Fed tightening their balance sheet, the staff's projection included a mild recession starting later this year with a recovery over a 2-year period. And the minutes of the Fed's March 21 to 22 meeting showed that. In May and June, the Fed's staff projection continued to assume the U.S. economy would be in a recession by the end of the year. Then at the July 25th through 26th meeting, the staff no longer judged that the economy would enter a mild recession towards the end of the year. The minute said that the staff still felt the economy would slow to a growth rate below its long-running potential in 2024 and 2025, with inflation falling and risk tilted to the downside. And when Elon Musk posted on Twitter, it would sure be nice to have 1 year without a horrible global event, he was asked, how long do you think a recession will last? He said, just guessing, probably until the spring of 2024. Now, interestingly enough, in previous videos, I talked about Bitcoin's halving, on how after Bitcoin's halving, we see Bitcoin go on a massive bull run from that period. So this would coincide with, massive volatility, potentially the crypto market going down to 2024. Then the Fed pivot, the Fed start issuing QE, pushing money into the economy, stop tightening on their balance sheet. And then we see, the first wave in the bull run in 2024, then the second wave in the bull run to the euphoria stage at the end of 2025. So that's still my consensus on what I feel is going to happen. But this year, it's going to be rough. It's going to be volatile. We'll see what happens. But one thing we need to look at is what made the difference between an in-the-moment recession that many thought was underway last year to growth that was surprised to the upside. So the forecast miss wasn't even really close. By the third quarter of last year, growth had rebounded to a rapid 3.2% annual rate and had remained at 2% or above since then for the GDP, higher than 1.8%. And the Fed considers that the economy's underlying potential, and Atlanta Fed GDP nowcast puts output growth for the current July through September period at a startling 5.8% for quarter three. So if GDP goes to a 5.8%, showing continued strong momentum from consumption and a surprising bounce in industrial production and home starts, well, what does that mean? If the GDP comes in higher, then it means that recession fears would dwindle down even more, and that would be good news for the crypto market. That would be good news for the economy, but it doesn't mean we're out of the woods just yet. And when we look at nominal gross domestic product for the United States, obviously it just keeps going up. So inflation, cost of living keeps going up. Cost in goods and services. And at some point, we're going to see, a crash. We're going to see a correction come place. You saw Q4 of 2019 leading into Q2 of 2020. We saw a drop from 5.4 million to 4.9 million. This was the last pandemic. There's going to be another pandemic happening. This is what Bill Gates is preparing for. This is what Joe Biden said. He says there will be another pandemic. He just told us that in one of his speeches.
We do need more money. But we don't just need more money for vaccines for children eventually. We need more money to plan for the second pandemic. There's going to be another pandemic. We have to think ahead. And that's not something the last outfit did very well. That's something we've been doing fairly well. That's why we need the money.
The guy's senile. He can barely put together two sentences, but he told everyone there's going to be another pandemic. So that probably slipped. He probably was thinking that in his head from what he was told by the people that are the puppet masters. They just tell him what to say. They write his speeches for him. They make his Twitter posts for him. They said, listen, Joe, there's going to be another pandemic. You just need to play it cool on these podiums. You need to walk up the stairs, not trip, go right to the podium and then just deliver the speech we give you and then walk off, shake the inspector general's hands, shake the military person's hand and go back in the White House and, we'll make you some tea and we'll give you a nice little Subway sandwich for that speech, okay? So just play it cool, but don't tell everyone, Joe. Don't tell everyone that we're going to be in a recession. Don't tell everyone that there's going to be another pandemic. And in his speech, he said, there's going to be another pandemic. So we'll see. We'll see that, but you got to prepare for it. When we look at the real gross domestic product right here, fluctuating from positive to negative, Q2 of 2020 was a disaster, negative 29.9%. Everyone was stuck at home. That was probably one of the worst. That was actually one of the worst things since the 1950s, the lowest that we've seen since the 1950s. And so then on the other side of the scale, Q3 of 2020 was the highest at 35.3% with the CARES Act, all of the stimulus checks. So here's what's interesting. This broke the economy, 2020. The economy was broke from 2008 when George Bush started, putting into play QE and started printing massive money. And then, we went to those wars and all that stuff. But this right here is what broke the economy, because you see what happened. And in 2020, you can see the years right here with the total outstanding credit card balances from 1999 to present. We're at the highest that we've ever been in billions, adjusted every single season all the way back until 1999. So you see Q2 of 2023, this is going to come down. When this comes down, the credit card bubble will burst, meaning Americans aren't going to have enough money to pay their credit cards back. But the dollar amounts keep growing regardless of what's in this basket of whatever's measured for, GDP. So nearly half of Americans need credit cards to cover essential living expenses. The Inside 1031 survey found that 49% of Americans depend on credit cards to cover essential living expenses. This is more common amongst the younger generation because 61% of Gen Z and 53% of millennials use credit cards for living expenses because, we've been born with credit cards in our hands. The moment that you could get a bank account, they asked you to set up a credit card and, they give you a limit of $3,000, $5,000, $10,000 for most young people. And most of them are allowed to open multiple credit cards with multiple bank accounts and just run up debt. So that's why credit card debt is at a peak right now. Conversely, only 26% of boomers rely on credit cards to cover essential expenses because, they're using debit cards and, they're a lot smarter with their money because, you've been around a lot longer if you're a boomer. And 45% of Americans have taken on more credit card debt during the pandemic. And so with the stimulus that was pushed out there since March of 2020, nearly half of all Americans have taken on more credit card debt. The survey found individuals who carry a credit card balance from month to month are more than twice as likely to report having more debt now than before the pandemic. And the Bureau of Labor Statistics in the United States, which is responsible for calculating the CPI, reviews and updates, the basket of goods at regular intervals to measure, GDP. And the BLS examines consumer spending patterns using data from surveys and consumption data to identify which items should be included, removed, or adjusted in the basket, and items that are no longer as commonly purchased by consumers may be removed from the basket, while new items that have become more significant in household budgets may be added. And so the process of updating the CPI basket is essential to ensure that the index accuracy reflects changes in the cost of living over time. And so when people use their credit cards to spend on different things like, your phone bill, transportation, if you're paying mortgage, food, whatever you're paying for, and then CPI is reflecting whatever they want it to show based on what you're spending it on, then the data is skewed, the data is manipulated, and it's not necessarily 100% accurate because the CPI basket of goods and services is designed to reflect the average consumption patterns of households in a given country, and it weighs categories like, food and beverages, housing costs, and like rent, homeownership, utilities, furnishing, clothing, footwear, transportation, healthcare, recreation, education, communication, other goods and services. And so if people are spending more money on, let's say, like transportation and housing, then they would adjust the CPI basket to heavily reflect that. And so most importantly, the government stimulus program during the pandemic enhanced all of this. It enhanced unemployment benefits. It injected cash into households that became accustomed to the financial cushion without having to work. And even when it dried up and you stopped receiving stimulus checks, a lot of people got used to spending cash that they didn't otherwise have because they were living off of their credit cards. And they were used to using debt for that and then just taking their stimulus checks and paying it off. But when you can no longer get a stimulus check and you have to go back to work, well, high inflation also fueled Americans' growing credit card debt, with millions living paycheck to paycheck. Typically, it's consumers' day-to-day living expenses or some kind of emergency expense that gets folks into trouble, not lavish spending, right? Lavish spending is what you want to spend on. Emergency expenses is what you have to spend on that you did not expect. And so credit card debt going up because, people were just spending money on things that, they didn't need. And then when the situation hit them that they had to spend money on to cover an emergency that they didn't have, then they're just racking up that card. And with record APRs, credit card interest rates rising caused Americans' outstanding debt to grow even faster because the average credit card interest rate rose to a record high of 20.4% this week, according to creditcards.com report. So the best way to tackle your credit card debt so you can get ahead and how this is going to affect the crypto economy is if you're in a hole, what do? You stop digging, right? You stop digging yourself into more and more debt. The only smart time to use a credit card is if you have enough income coming in on the front end to be able to cover those card payments. And even at that, you have to lower your expenses that you're using your credit cards on in case of an emergency where the income coming in on the front end cannot pay off those credit cards long term. And so if you have a cut in income, maybe your job changes, your career changes, maybe your income gets cut, maybe your company goes out of business, you have to prepare for stuff like that. That's why it's important to keep your expenses low when you're scaling your income or you're an entrepreneur. You don't want to spend that much money until you have passive income to be able to cover your liabilities. And so when we look right here, another key indicator and another key thing that will determine whether we're going to go into recession or not is the 10-year to 2-year Treasury inversion rate right here. And we can see that we're still inverted. I mean, we're at negative 0.64%. And if we look back to when we were inverted before, when we broke out of this, we saw as May of 2007 for the subprime mortgage crash. We also saw the dot-com crash in the year 2000. We saw 1990, that crash. Then we saw all the way back to, it bobbled around here from 1978 all the way until 1982. And so when we look right here, when the yield curve inverts, meaning what this means is that short-term rates in bonds are typically higher than long-term rates. It's often seen as a significant economic indicator. It can have implications for the broader financial markets and economy. And here's what this typically suggests. People expect a recession because an inverted yield curve is an important sign indicating that investors are seeking the safety of longer-term bonds due to concerns about economic prospects. Historically, yield curve reversions have been associated with economic downturns. When I show you what happened in the stock market, you'll see why. When we look at market sentiment, an inverted yield curve can reflect a shift in investor sentiment as they may anticipate lower interest rates in the future due to economic weaknesses. This can lead to a decrease in demand for borrowing and spending, which can contribute to a slowing economy. Central bank actions as well too, with an inverted yield curve influencing the central banks like the Federal Reserve in the US to consider lowering short-term interest rates in an attempt to stimulate economic activity and prevent a more severe downturn. And in the financial markets, inverted yield curves can lead to a volatility as investors react to the potential implications for the economy. The stock market might experience increased uncertainty and potential sell-offs. Now, in terms of the stock market, right, the crypto market is still new, so we can't go all the way back to the year 2000 or before then. But when we look back here, May of 2007, when I pull up the yield curve right here, May of 2007, we were right here. So we were at negative 0.02. We just came off of a low of negative 0.11, and then we went from negative 0.02 all the way up until 1.8, and then ultimately at the peak of like 2.8 to 2.84. And so when this yield curve flipped and it went drastically into the positive, well, what happened to the stock market when that inversion took place? Well, we saw the S&P 500 was about 1,539, and then it took about 487 days after it inverted to then trade to the downside, and we saw the stock market drop over 54% from 2007 to 2009. So it took 2 years to crash further than that. If we go all the way back to December of the year 2000 and we were to pull up the inverted yield curve, we went from negative 0.47 in March of 2000. Then in December of 2000, we went right into the positive and we drastically went to the upside. By August of 2003, we were all the way at 2.50. And so by 2003, what happened here? Well, the S&P 500, right when it went into the positive, we saw the stock market rally a little bit to 1,373, but then ultimately we saw a massive drop of around 42% by October of 2002 and then March of 2003. And so once the yield curve flipped to the positive, it peaked out and then it started coming back down again. Then that's when we started the next bull run for the stock market. And so the next bull run for the stock market from 2003 until the peak of 2007, as you guys can see, all the way back right here from 2003 to 2007, the yield curve went down again. It started coming back down, going inverted. And so during this volatile roller coaster right here, when the yield curve was inverted, the stock market, rallied up. Then once it went to the positive, then the stock market crashed, right? So this was a reverse effect. So as it came up, the stock market went down. As it went down, the stock market went up. Then from 2007 right here, all the way until 2011, what happened? Well, the yield curve went up. So from 2009 until 2011, then the markets were rallying from that point. So what could happen here? Well, this is dicey. This is very dicey because we're at negative 0.64. The last time we were there, if we go all the way back to 1989, we were only down that low back in 1970s, right? 1970 right here. We saw we were at negative 2.1 in 1980 from that period, but that was really volatile. So this could be compared more to something like this back in the 1980s than it would for 1989 or 2000 or 2006 because we're drastically lower. But at some point, this is going to come back up. When this comes back up, that's why the Big Short, Michael Burry, is projecting a massive crash in the stock market. So we are almost, we pulled a 786 retracement, and I talked about this cup and handle formation. But let's say, for example, if we see a sell-off further in the stock market and we don't hold inside this handle, we break to the downside, we could see a crash come all the way back down to the level pre-COVID of February of 2020, all the way back down to these levels back down here if we were to see something like this take place. And ultimately in the stock market, I talked about how I just expect massive volatility over the next 10 to 20 years. That's why I'm not in the stock market right now. But in the crypto market, stocks are tied to crypto. However, it's inversely correlated to the dollar. And when we look at the dollar right now rallying while the crypto market sees a sell-off, we need to see a rejection in the DXY in the dollar to trade to the downside to see any sort of rally in the crypto market, because if the dollar trades bearish, then cryptos would generally trade bullish as people flee the dollar and move it into cryptocurrencies. But the Federal Reserve's ongoing effort to shrink its balance sheet may end earlier than what everyone thought. This is one of the most important things that would affect the stock market to complete a cup and handle formation, to break all-time highs, and to keep trading higher. The Fed needs to issue QE, quantitative easing. Fed watchers reckon it will most likely have to stop in some form its current shedding of treasury bonds and mortgage-backed securities next year in 2024 due to rising shortfalls of the financial sector liquidity that may already be happening. And as you guys can see, it's happening right now, and it's punishing everyday Americans. A New York survey conducted ahead of the November policy meeting found that major banks are predicting the runoff to end in the final quarter of next year of 2024. And so Goldman Sachs, however, forecasts the runoff will likely split into late 2024, maybe even 2025, early 2025, before the Fed changes gear, highlighting the uncertainty that still haunts this part of the central banking outlook. So if they, when they pivot, it's not if, the Fed will pivot and the Fed will start, putting more money in the economy. But when that will happen is anyone's guess, because the Federal Reserve's balance sheet, they began cutting its bond holdings back in June. So how far we'll get until it stops is an open question that everyone's debating right now, because the Fed has been shrinking its holdings of bonds since the summer as part of its broader effort to increase the cost of borrowing to help slow the economy, to bring inflation down. They do this to bring inflation down because if they keep adding to their balance sheet, inflation gets out of control, and that pumps the markets, right? That pumps risk on assets because that devalues the dollar. That's why we saw the dollar crash when they started adding. But it helps slow the economy down from levels seen back since the 1980s. While officials haven't given an end date for this process, economists have assumed that officials are expecting it to last for around a couple of years. So by 2025. And so when you think about that right here, what does that mean? What does that mean for you if they're not going to start adding to their balance sheet and putting more money and the bank's reserves at the Fed? On November 30th, Jerome Powell said he didn't believe the banking system was running short on reserves, but he also suggested the central bank will manage its holdings in a way that could cause the drawdown to end sooner than once expected. Demand for reserves is not stable. It can move up and down very substantially, so we want to stop at a place that's safe, he said. It's really a public benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system, in the financial system generally. So if they just keep tightening, if they keep tightening all through 2024, while I raise interest rates and they keep tightening the balance sheet and they don't let up at all, something will break in the economy, and they don't want that, because if something breaks in the economy while they're in office, that's not going to look good on their resume, right? Re-election, it's just not going to happen. And so they want to keep the economy into as safe as possible, into a soft landing, which gets more difficult the longer that they raise rates, the longer that they tighten on their balance sheet. So at some point here, and this is why 2024 to 2025, they'll start QE again, and then inflation will rear its ugly head back again. That will cause the next crypto bull run. Because when the Fed puts more money back into the economy, where does that money go? Well, that money's going to go into the crypto market. It'll go into the stock market. So even if the stock market, sees a crash, that gives you more time to back up the truck. In the crypto market, if it crashes down lower, that gives you more time to back up the truck all the way to the bank, grab the bags, pack them and stack them, leave no bags left behind, because the spending power of the dollar is just going to continue to go down in value. That's a fact. Blockchain technology is going to continue to go up in value. That's the truth. And regardless of whether the crypto market goes up, down, sideways, it's the best possible time to accumulate as much as you can afford to lose. Again, don't buy, don't sell, don't put your family farm into the crypto market. If you're just tucking away a small percentage of your net worth and you can afford to lose that, what could happen if it becomes, the next sector of the S&P, if it becomes the next big wave, like what happened with Apple, Microsoft, Tesla, tech stocks back in the, early 1990s. Imagine if you were involved with Tesla, if you were involved with Apple, if you were involved with Microsoft, if you were involved with Facebook, if you were involved with Uber, if you were involved with Lyft, all the way back right here when the S&P 500 was all the way down in the 300s. And then we saw this massive bull run. Sure, we saw the dips of, the dot-com bubble crash because a lot of these companies were overly inflated. But crypto with blockchain technology is the new version of this. And the fact that it's still in the infancy stage, imagine what's going to happen over the next, not just year, 2 years, but over the next few decades, over the next 20 years, 30 years, 50 years. By the time, if you're 30, 40, 50 years old, imagine when you're 70 or 80 years old and you took this seriously and you focus on accumulating as much money as you possibly can, as much crypto as you possibly can, as much precious metals as you possibly can, and just keep stacking, stay active, stay productive, and as always, stay bullish. I'll see you on the next video. I will see you on bullrunners.com. If you want to see our #1 way to prepare to have a recession-proof business model, then check out the link in the description of this video, and I will see you on the next one, and I also will see you on the beaches of the moon. You know what to do. As always, stay bullish.